This lesson is about internal retracements, and most traders are familiar with internal retracements. They're often called fib retracements because they're part of the Fibonacci series of ratios. And almost all charting and trading software has the ability to make internal retracements, and the reason we call them internal retracements is because they are retracing or within a particular section. Internal retracements are used to help identify the end of a correction, and it's really important to understand how and why they're used. That is, to identify the end of a correction. Those retracements that we use most frequently are all part of the fib series of ratios. Well, the 23.6% is in parentheses because it's rarely used, only in a particular unique situation where we would expect a shallow retracement. We'll talk about that later in the course. The 50% and the 61.8% are underlined because they're the most frequent retracement levels for a correction. The 78.6%, you might not be familiar with that and might not have used it. You're going to find it's a very, very valuable piece of information to have where the 78.6% retracement is, because usually that's the maximum level for a correction before a trend continues. And the 38.2% is not underlined because it's relatively infrequently used, and it's used under particular situations, which again, you'll learn about. So each ratio is most applicable for particular market positions and market conditions, which we'll describe later in the course. But first, let's just learn about simple, basic internal retracements, which you're probably already familiar with. The section will be very short, just to make sure we're all on the same page with how retracements are made and we're all using the same language. So this is SPX daily data, and the A and the B are not related to Elliott wave at all. It's just from point A low to the point B high. We're going to do the internal retracements. So most software, we can choose the retracement levels and some other choices that we have. In the Dynamic Trader software, we'll just take a look at how we make these choices real quick. And it's going to be probably almost the same with whatever software you have. You should be able to choose whatever levels and ratios that you want to use for those retracements. So I have chosen here the 38.2, 50, 62, and 78.6. In the DT program, we can choose various levels, and then we can save them as a set. I call this set just dynamic, just because it's the typical dynamic retracement levels that I use for most internal retracements. You should also be able to have some other choices, hopefully, just on how it's displayed. And again, we can choose the color we want for the ratio. I've just chosen them blue, and except for the 78.6%, I choose red just because that's such a critical retracement level. If a market makes it that far, that's usually the extreme for a correction around the 78.6% retracement. So it just kind of stands out. Then we're able to choose whether we want a thin line or a thick line. And also whether we want to do retracements by the high-low of the bar or by the closes of the bar. And you definitely, hopefully, have that choice because, as we'll see, we do a lot of analysis just on close-only data. So we want to be able to do all of our price analysis and everything else on closes, as well as on the high-low of the range of the bar. And then there's just some choices on what's displayed for the retracement levels, and we'll see those once we do the retracements. So once again, almost all charting programs are going to be very similar to these types of choices and layouts. So let's do OK with this, and then typically you just click on, this is the icon for retracement from low to high. So typically you just click on the low, then you click on the high, and I think almost every charting program will do that about the same way, and it makes your retracement levels. So as you can see here in DT, we have the exact price level displayed. We have what type of price factor we've done. In this case, RET stands for retracement. And you'll see when we do other types of price analysis, there's other codes for what type of analysis it is. And then we always have the exact or what retracement ratio that we're using. So let's just go down to 50%. 50% retracement of this particular advancing sections around 3204.05. It's a retracement. RET is the same as for internal retracement, and it's 50%. So we have all 4 of those retracement levels. Pretty simple. Almost all software does it pretty much the same way. So this is, it's also the SPX daily data over a few months period of time. So I just wanted to show you on this. This is obviously a pretty relentless bull market during this period of time where the market continued to make higher highs and corrections and then followed by a higher high. This is just to show you that most of these corrections were complete around one of the key retracement levels. In this case, they were all complete around the 50% or 62%. So we had this initial advance, a correction just short of the 50% retracement. We continued on to a new high, correction again, just short of 50% retracement. New high, correction to around the 62% retracement. New high, correction to around the 50% retracement. This is just to illustrate that most corrections are around these retracement levels, but not right on. You know, a little early, a little after, a little before, a little short of it, a little beyond it. We don't want to anticipate that a market is always going to reach exactly one of these levels, or it's going to stop right at the level. But this is to illustrate that most of them are right around these levels, and we're going to use other price factors and other technical factors to help identify not only which level the market is likely to complete the correction at, but we're going to have more of a zone, not a specific price, but a narrow range zone as the result of several price projections that fall very close to each other, and we'll be learning a lot about those in future lessons. But this was just to illustrate most corrections do happen right around one of these key retracement levels. So our challenge is going to be to identify in advance, more than likely, which level is going to be that retracement level and how important that level may or may not be. Well, let's just do a couple more retracements. Again, I'm going to do the retracements from point A to B, from the low point to the high point. And we're doing the typical, what I call the dynamic retracements. I just pretty much automatically do those for each level. And then we take a look at where the market's at around those levels. We can see already in just a few days, this is Treasury notes, by the way, the 10-year Treasury notes. The market came down, this Treasury notes came down very strongly to right around the 62% retracement. And let's just add some data on. And we can see that a few days later, it poked below it. It didn't make a new closing low. Below it, bounced right back up, and then continued on to a new high. So once again, this is just illustrating how effective these retracement levels are, but also how we really want to have some other information that indicates whether that retracement level is probably going to hold, whether it's probably going to be the maximum retracement for this particular correction, and all those sort of factors, again, which that's what this whole section of the course is going to be about. Well, this is 240-minute data for the ES, the futures contract for the S&P. Well, let's do our retracements from the low to the high. There we go. And again, we've got them on here. Which one's it going to be? Well, we don't have that information yet, but let's add some more bars and just see what happened. So typically, the 38.2% is not often effective except under specific circumstance, which you'll learn about later in the course. Typically the 50, or most frequently it's around the 50 to 62% retracement level. As of the last bar in this chart, markets come down to the 50% retracement. We'll just add some more bars. Before I add more bars, let's go ahead and erase the 38.2%. What might be helpful here to identify if indeed this correction is likely to be, if it's making a correction, I should say, around the 50% retracement, or is it more than likely to continue lower? Well, this will be a little hint as we learn later on how we integrate the pattern position with the price position. What's the pattern position as this market, the 10-year notes, has declined and tagged that 50% retracement within a couple of ticks? Well, if we believe this decline is making a correction, certainly as of this point in time, it looks like it's made three sections, are potential ABC. So if we made a potential ABC to the 50% retracement, and corrections are very frequently in three sections, that itself might indicate that we've completed that correction. So again, we'll get into that a lot more later in the course. But as you can see, the price relationships and the price positions are going to be most valuable within the context of the pattern position and some other technical positions in the market. Here we have 50% retracement continued on to a new high. So that's internal retracements. Again, you're probably all familiar with them. You're going to see these in almost every chart, and you're going to see how valuable they'll be, particularly within the context of other price relationships that fall near one of the retracements, the pattern position, and then eventually you'll learn about some other technical momentums and indicators that will also help us to identify if a market reaches one of these retracement levels, whether it's going to hold for that correction or not. Okay, let's continue on and learn about something that may be new to you, but is really valuable, and that's external retracements. The next price factor we're going to learn about are external retracements. Most traders are not familiar with external retracements, and they're very important, and they're very useful, and they have some particular use and information to give us for most markets and most time frames. So external retracements are always greater than 100%. And that seems kind of odd. It's a retracement. Shouldn't a retracement be less than 100%? Not necessarily. If it's greater than 100%, it just means that retracement continues beyond the beginning of the section that you're retracing, as you'll see in just a moment. So most of the external retracements are also related to the Fibonacci series of ratios, with one important exception. And external retracements are used to help identify the probable extreme to complete a trend or a counter trend. And this is very important. It's not just another support resistance level. It's used in specific situations to help identify the end or the extreme of a trend or a counter trend, as you'll learn. So the external retracements, the ratios that we use, we begin with 127.2%. Now that ratio is not directly part of the Fib series of ratios. 127.2% or 1.272 is the square root of 1.618. So it is related to it, and it has a lot of relationships in sacred geometry, as we call it, philosophical geometry, ancient architecture, that type of thing. Boy, you're going to find that it's really valuable when we use external retracements to identify the probable extremes of to complete a trend or a counter trend. So we use that ratio even though it's not directly a part of the Fib series. You can also use 138.2%. I don't use that. You may see some other analysts or traders use that, and you can play around with it. It would be so close to the 127.2%. We definitely don't want to use both of them. But you could use the 138.2. I just think you'll find that the 127.2 is going to be more frequent, is going to be the target for the end of a trend or a counter trend. So the next ratio, of course, is the key, the gold mean, or the 161.8% or 162%. So the two I have underlined, 127.2, 161.8, those are the ones you're going to use the most frequent to identify the end of a trend or a counter trend, the last final section. I also have showing here the 261.8% and the 423%. They're directly related to the Fib series of ratios. And I have them in parentheses because they're only used under special circumstances and particular sort of pattern structures to identify the end of a pattern. So we don't use them very often at all. I'll give you some illustrations of when they're used within this course. But we always focus on the 127.2 and 161.8. Each ratio is always, as usual, most applicable for particular market positions, and we'll describe later in the course. So this is some daily data. It's a stock, Apple stock. And let's assume that our pattern analysis, our technical analysis, whatever, is indicating that this stock is getting near a fairly important high, a high that's more important than the ones that I'm showing on the chart. In other words, it's going to complete this section of the advance, at least from back at this low, which was 2 or 3 months prior to the last bar in the chart. And as you know from just some basic Elliott wave and from our Elliott wave course, if we can identify clearly defined 4 sections up, which this looks like pretty good for that, 1, 2, 3, 4, the 5th section is likely to finish this advance. So we're getting a little preview of how we use these particular ratios and price relationships based on what the probable pattern position is. So if we believe we're in the final section up of this trend, at least from the low back at this point, early on this chart, we would want to do the external retracements, and those 2 key ones, the 127 and 162% external retracements, as the probable kind of a broad zone from where, in this case, it would be a wave 5 or the final section up should be complete. So let's put those on, and then we'll describe it a little more once we get them on there. So I'm going to click on our retracement levels, and I've got chosen the external retracement set, which is 127, 162% retracement. I just do the 127. I color it green because more than likely this trend will continue at least to that level. So now you're getting another hint of how we can use some of these price relationships to identify minimum and maximum levels probable depending on the wave structure, which again, we'll learn a lot more about that later on. Then I have the 162% or 1.618. I have that in red because typically that would be the maximum of the final section. So we're going to do the external retracements for those 2 retracements. There we go. Let me bring the chart down a bit. So in our external retracements are the most helpful to identify the end of a trend or a counter trend. In this case, it would be the probable end of an impulse trend. So they're more important than just simple support and resistance levels. Much more important. They're identifying the probable end of the trend or counter trend. So we have those on, and more than likely this trend will continue at least to the 127% or 1.272 external retracement. And if it gets anywhere near the 1.618, we want to be on alert to other technical factors that were near what is typically the extreme for that final section. So I'll add some more data on here. Again, this is the Apple stock daily data, and we advanced right up into this zone, the 127 to 1.618 zone, and it looks like we made a pretty sharp reversal from that zone. So indeed, we reached at least the minimum target, and once we're in that zone, we want to be alert for a potential reversal and the completion, in this case, of a 5-wave trend. So I've just added quite a bit more data on. As you know from the pattern course, that we've made the new high and we've come down and done a closing overlap on what I got labeled as a wave 3. That's an indication that this section is complete, which would complete the higher time frame section, this 5-wave advance as well. Then, of course, we continued down and we've actually traded below what I got labeled as the wave 4 swing low. So again, this trend, this impulsive trend, was complete right in the zone of the 1.272 to the 1.618. Very important zone to be alert to if our other technical analysis, including pattern analysis or maybe multiple time frame momentum position, is indicating the market's near the completion of a trend or a counter trend. This is some closing data of this IBM, the stock IBM. So this is IBM daily data. It's the close-only data. And let's go under the assumption we believe the higher time frame trend is bullish and IBM is in the process of making a correction, potentially an ABC. We know that correction should be a minimum of 3 sections. So this has the potential for being an ABC zigzag. Well, if the final section of a correction is usually at the 127, at or near the 127 or 162% external retracement, we'd want to do the external retracements of, in this case, the wave B. So let's do that, and let's check out which retracements we got checked off here. There's 127, 162, and I got checked off closes, so we'll do them by the close. So let's go ahead and do those on this chart. So we have the 127, 162% external retracements of the wave B. And of course, because they're external retracements, they go beyond the beginning of the wave A. And we can look at this as the probable, fairly wide zone of where a final section of a wave C would be complete, with a minimum around the 127 and a maximum around the 162. So that's pretty valuable information to have. We'd certainly want to have some more information with internal retracements and alternate price projections, but we'll get to that pretty soon. So because the 127, 162% external retracements are most valuable to identify the end of a trend or a counter trend, one of those ends of a counter trend could be a wave C. And you'll find that very frequently a wave C is complete around these 2 external retracements, one or the other of them. So I'm adding some data on, and we can see indeed that the IBM declined to at least the 127% external retracement. It's reached, as of the last bar in the chart, and again, this is close-only data, it's reached near the 162%, so we're getting near what is typically the extreme and the end of this correction. So let's just add some more data on, and well, we can see that IBM then advanced strongly and closed well into the range of what I got labeled as wave A low, typically a signal that at least the market's in a position to have completed a correction right within the 127, 162% external retracement zone, and very near the maximum typical. So again, each of these retracements are labeled by the exact price, a description, in this case external retracement, and a description that C means the external retracement is done on the close. And then, of course, the actual ratio. Let's take a look at one more example. This is the SPX, and it's 60-minute data. Once again, all these price relationships are relative to any actively traded market, whether it's stocks or futures, indexes, or Forex markets, and any time frame. So let's assume that as of the data on this chart, which has made a new high above this last significant high, that we believe the market's in a position to complete a higher time frame trend. Possibly this is a wave 3 and a wave 4. Maybe it's making a wave 5. However we want to label it, we believe that our other technical analysis and pattern position, etc., says we're pretty near a higher time frame trend and the end of that trend. So where price-wise is it likely to end? Well, again, the 127, 162% retracement. Let's see if I've got those chosen. I do. This last section, declining section, is very probable to be the target zone for this final section up, where it should reach at least the 127%, and more than likely it would be complete by the 162%. We can see as of the last bar in the chart, indeed, it's reached at least the minimum level. It's right in that broad zone of the 127, 162. So how might we even narrow the zone down a little bit more? What if we believed this is the last decline, and this is the final section of the smaller time frame or the smaller degree? If that would be the case, maybe this is a 1 and a 2 and a 3 and a kind of a flat wave 4, and so this is the last section up from this point to complete this section, and we also think that this section is the last section up to complete a much longer trend, a much longer impulsive trend. Well, pretty simply, is we do our external retracements of the range of this last section, and that gives us the range that would probably complete the section up from back here. And if it completes this section, and if this section is the final section of a much higher time frame trend, then we've narrowed down the probable price range for a much higher time frame reversal and end of, in this case, an impulse trend. So you'll know from Elliott wave terms, let me just put these in, potentially a 3 and a 4. So this 5 would complete a much, much higher time frame trend going back many weeks, if not months. And if this happened to be a 1, 2, and a 3, and a 4, then whenever we've completed this final section, we've completed the much higher time frame trend. And this, as you're going to learn when we do multiple time frame price analysis, boy, sometimes we can really narrow into some very narrow range price targets to complete some longer term and higher time frame trends. Very valuable information. Well, let's take a look at what we got here. So as of the last bars in this chart, we're right in to the price range to complete the section up from back here. And because we're also in the higher time frame price range, boy, this is a real significant position for this market to be in. And let's just add some data on. Needless to say, this is the well-chosen example, but it's an important example for how we're going to learn to use multiple time frame price positions to identify narrow ranges to complete a correction or to complete a trend. And so far we've had a much greater decline than any since at least what I got labeled this wave for, and more than likely we've completed the much higher time frame trend. So that's our external retracements. They're really valuable to identify the end of an impulse trend or the end of a correction. So next, let's learn about alternate price projections. This lesson is about alternate price projections. And an alternate price projection compares sections trending in the same direction. And the shorthand we have for alternate price projection is APP. The alternate price projection is made from 3 points where the range of a section is proportioned and projected from a third point. And in alternate price projection ratios, they're all related to the Fib series of ratios. They're all related to the Fib ratios of growth patterns found throughout nature. And alternate price projections are used to help identify the probable extreme to complete a trend or a counter trend. So the ratios that we use are 61.8%, 100%, 161.8%, and 261.8%. I've underlined the 100% and 162% because they're the most frequently seen. So we focus on those and we look at the 61.8% as a minimum and the 261.8% as a probable maximum, as you'll see in examples throughout the course. And each ratio, as with all the other price factors, is most applicable for particular market positions, which we'll describe later in the course. But first, let's just get a clear understanding of how we do alternate price projections. Well, this is the ES, it's 240-minute data. So let's take a look how we can do an alternate price projection and how that can really help us to identify, in this case, the end of a correction, potential ABC correction. So we have this trend up from this low to this high. Was over a couple, 2 or 3 weeks time period. It's obviously, I don't have labels on it, but it's an obvious impulsive trend. And it's obvious that this market, the ES, is making, if it's making a correction at least, it's of much higher time and price, higher degree than any of the little 3 to 5 bar corrections that were made during the impulse trend. So if we believe that the higher time frame trend is still bullish and that the ES is making a correction, then we can use the alternate price projection as well as our retracements to help identify the high probability, relatively narrow price range from where the correction is likely to end. So let's do that. Let's begin by doing the alternate price projection of this initial section down. I got it labeled a wave A from the wave B high. So we measure this range, and we can see the range was 103.5 points. We measure it by the key alternate price projection ratios of, and I generally just do the 100 and 162% because I can just look at this and see that this has made almost a 50 to 62% retracement. So a 62% alternate price projection is probably not even going to reach this low. So I'm going to do the 100 to 162% alternate price projections. So let's go up to our alternate price projection, our 3 points. This is the icon for those that point down. And once again, most software will have the same type of setup, the same type of choices to be made. However, it's important, I should have mentioned this earlier, there's a lot of software that calls, as well as traders and analysts and so-called educators, that call these expansions, price expansions. They call the 3-point alternate price projections price expansions. They're not expansions. There's a different price relationship that is related to expansions. However, for 20, 25 years, this has been thing with me is trying to get people to properly name and have the proper terminology for what they're doing. So these are alternate price projections because we're looking at swings, alternate swings in the same direction. They're not expansions. An expansion would be taking the range of one section and expanding it downward or upward. We'll get to those at another lesson. But these are alternate price projections. Okay, we're going to measure that range by 100 and 162. We're going to do it by range. We can do it by percentage change. I'll do some percentage change later on in this chapter and show you the differences. We can choose between high-low closes and then, of course, the descriptive labels. So let's just do our basic alternate price projections of 3 points. And pretty simple, straightforward. So the beauty of this is that sections in the same direction, in other words, alternate sections, are usually related by one of the fib ratios. Not all the time, but usually. And so more than likely, if this market, if the ES is making a corrective decline, and if it's going to be a 3-section decline, meaning a ABC type zigzag, more than likely the range of the wave C is going to be related to the range of the wave A by one of the key fib ratios. And we'll get a little ahead of ourselves now, but when we get into the end of wave chapter, you'll see that a wave C is most frequently related to A by 100%. So it'd be around, in this case, that'd be 38.41. So that's how we do the alternate price projections. Now let's add a couple other price factors that we've already learned. We'll see how we start building up with different price factors to identify specific narrow range target zones. So first, let's just do the basic retracements of this advance and see if one of those retracements, one or more, falls very close to one of these two alternate price projections. So let me go on and make sure I got the dynamic retracements, and let's make sure that we're doing it by range and not by closes, and we are. So we'll go OK. See, we got 38, 50, etc. So let's do our retracements. And we can see, let's just eliminate the 38%, because that's right near where that low is. Oh boy, we've got the 100% alternate price projection just within a couple points of the 50% retracement. And then we have the 162% alternate price projection, 78.6% retracement, quite a ways down below that. More than likely, with the information we have, is if the ES is making a correction, it would more than likely make it right around this 50% retracement or right around the 78.6% retracement. Probably wouldn't make it around the 62% retracement because there's not an alternate price projection near there, meaning there isn't a projection where this range of wave A would be related to the range of wave C, which is usually the case. So I just eliminated it. So we've done retracements, the internal retracements, alternate price projection. What's the third relationship that usually helps us identify the end of a correction or an impulse trend? Well, that would be the external retracements of the wave C. So let's do the basic external retracements of the wave C, and that would be the 127, 162% external retracement. Let me click on that. Let's do that. External retracements of B. Oh boy, look what we got here. The 127, 162% external retracement of wave B overlaps almost equidistance on either side of the 50% retracement, internal retracement, 100% alternate price projection. More than likely, If the ES is making a correction, in a three-section correction in ABC, it's going to be made within the broad zone of 38.32 up to 38.56, and we would be focusing on right in the middle of that zone around 38.41, 38.44, 45, right around in there. This is a fantastic piece of information to have, because if the ES continues to decline and reaches into this zone, then we would be looking for an opportunity to identify a reversal and a go-long strategy, because it would be in a position to have completed a correction. Let's just add some more data onto the chart. Well, as of the last bar in the chart, I'm going to just eliminate one so we can look at this last bar. Again, it's 240-minute data. Oh, look how this came right down, right into the high probability target zone for a correction. And then, again, this is 240-minute, 4 hours data. Came up and closed near the high of that bar, and then continued to advance and continued to advance. And wow. Let's just add some more bars on here. There we go, eventually to a new high, confirming that indeed we've made a correction right at the 100% alternate price projection, 50% retracement, and within that broad external retracement zone. Let's look at another example with the alternate price projection. And again, we've had an impulsive trend down. And let's say that this is, we believe it's not the end of a bear trend, that there should be a correction followed by continuation of the bear trend. So once again, we have a potential A, B. So we measure the range of wave A, and then we project it from the wave B low by the various proportions of the range. So we can do it by range, or we can do it by percentage change. Let me show you the difference. Let's check out our alternate price projections here. So we've got the 100 and 162 checked off, and I've got range checked, high, low, of course, and then the various labels on it. So let's do our alternate price projections of what we've got labeled, this wave A, this section up, and we're going to compare those ranges and the proportions of the range with the next section in the same direction, and otherwise the alternate section. And we have the 100% just a little bit above the last bar in the chart, and the 162 quite a bit above it. And again, APP for alternate price projection. Now let me do it by percentage change. There we go. I'll click off. Everything's the same, but we do it by percentage change. So I'll measure the, whoops, I got to click on that. I'll measure the percentage change of the range of that A, and then project it by the ratios from the wave below. So let's take a look at this. This advance was 178.36 points. This is Tesla daily, by the way. I'm not sure if I even mentioned that when we started. 178.36 points, or a 33% advance. Oh boy, in 3 days, 33%. That's why Tesla is so popular trading stock. So 33%, 178 points. Then it had a decline of 17% from this high to this low, or 126.84 points. So if we do 100% of the range of 178.36, that would be at 769.37. If we did 100% of the percentage change, in other words, we did 33% up from this low, it'd be a little bit higher. It'd be at 786.40. So we've got 100% of the range alternate price projection, 100% of the percentage change alternate price projection. And sometimes I'll do both of these and just get this little, here's a little range right within here, is that very high probability that if the market's making a correction, if Tesla's making a correction, and particularly if it's making a three-section ABC correction, this would be the ideal target zone to complete that correction. And the maximum target zone, which is typically the 162, boy, that comes right up to the high, and actually on percentage change, it's above the high. So it'd be beyond what a normal correction, well, what any correction would be, because it'd be making a new extreme. So something else would be going on. So if I were just to make these two projections, I'd say we got a real high probability if Tesla is making a correction to terminate that correction right around 769 to 786. And then, of course, I'd want to do the basic retracements, internal retracements. Those are really important. And look where the market is now and where the 62% retracement is. It's right near the 100% alternate price projections. So I can just keep that 62%. 78.6% is out here by itself. If we continued above this area, I'd keep it on. But right now, I'm going to clean the chart up and just erase that. I'm going to erase the ones all the way up here. They're obviously beyond, and it looks like I erased the 62. So let me do that one more time. Apologize for that. There we go. And then I'll do a keep me. We'll keep just the 62. So boy, we've got a pretty narrow range here to complete a correction within a bear trend, to which once the correction is complete, more than likely the bear trend will continue to a new low. And so these are just real important. Of course, the retracement is really key, particularly because it's the 61.8% or 0.618 retracement, because most corrections are around 50 or 62%. And that's within just a few points of the 100% alternate price projection by range, which is within a few points of the 100% alternate price projection by percentage change. So if Tesla is making a correction, bang, I suspect on that day it's completed the correction. Maybe. Oh, there we go. So, do you think when we combine alternate price projections with internal retracements and external retracements, you might have a good tool to identify in advance relatively narrow range targets to complete a correction or to complete an impulse trend? Well, the answer to that is you bet. Yes, you do. Let's look at one more example. So this is silver daily data. And we can see that over the several weeks, it looks like 2 or 3 months decline. It's very impulsive. I'm not even going to try and put a wave count on it. We could force a wave count in there, but the point is, it is an impulsive decline. And our objective is to identify when it's in a position to complete that decline. So one of the things we can do when we don't have a specific wave count is we can just do all the alternate price projections and see if they happen to cluster around each other. We can look at these sections down and we can see a lot of them are fairly similar in price range. So I've marked them off, measured by price range and by percentage change, each one of these declines. And let's just look along the ones in the bottom before we start making projections on the chart. We can see that they range from about 6.26%. It's easier, by the way, just to identify them by percentage change here. Around 10%, about 9%. And then the big one, which was the most recent one, about 14.5%. Well, as of the last bar in the chart, it's already declined from the last swing high, about 9.5%. So it's getting fairly close to what the maximum has been on the way down. So do we need to do all of these alternate price projections? No, we can just do maybe the last one or two, the ones that are in the higher range, like this decline, which was about 14.5% or 3.795, or this one, which is a little over 10%. I'm just going to do this maximum one, because more than likely the final one is not going to exceed that. We can see, I'll bet there's some news event that happened here. So if we have other technical analysis that would indicate that we're at or near the extreme and about to make a trend change, maybe it's some time factors or some time cycles or some weekly momentums. We'll get into all those other factors later on, but there's something that's indicating we may be in the final swing down. And if we're in the final swing down, what should typically be either the target or the maximum? So I'm just going to do the alternate price projection of the largest swing down so far. So let's click on that. We'll measure that range. We'll measure it from the last swing high. And we could say that more than likely, at least, if this is the last section down, it's probably going to be around some cluster of these other alternate price projections. We don't have to do them all. Let's just do the maximum and say that's probably about the maximum on the downside. Now, ideally, we could do some other price factors, such as the 127, 162% external retracement. Because if this indeed is the last section down, that's typically the last section terminates around the 127, 162% external retracement. So there we have the 127, pretty near the 100% alternate price projection of the largest section down, at least so far. So we're already building up a zone of alternate price projection, external retracement. Now here's one other alternate price projection we can look at. It's particularly relevant with certain wave structures, but we can look at it if we're in the final section down. We can measure the entire range prior to the final section, proportion it by 38 and 62%, and then project it from the last swing high. So let's take our alternate price projection icon there, right-click on it, and I'm going to do none. Then we're going to do 38 and 62%. There we go. Click from the high to the low, and then we're proportioning that entire range by 38 and 62%, and we'll measure those. 38% is, above where the market's at, so that's not relevant. 62% happens to be right in this tight range of the 127% external retracement, 100% alternate price projection of the largest swing down. Boy, we have built up a very narrow range with a high probability being, in this case, the maximum target on the downside to complete the entire trend down. So again, the one alternate price projection we haven't talked about yet that we just used was the 38 to 62% alternate price projection of the entire decline up to this point in time from the last swing high. And that fell right in that range. Oh, what a fantastic little target zone. Okay, let's add some bars onto the chart. So, as of the last bar in the chart, we're not done yet, but boy, it's just had a big wide range day down right into this price zone. Now, before I continue to add more bars on, let's take a look at this last section. That looks like it could be a really nice 1, 2, 3, 4, and 5. Well, if that's the case, if this is the final section of this trend down, this smaller time frame trend, typically where would it terminate? So let's do the 127, 162% external retracements of that little advance. There we go. Oh, look at that. They overlap the zone that we already had of the higher time frame projections, including the 100% alternate price projection of this decline and the 62% of the net range of this decline. What else could we do here? Well, how about the 100% alternate price projection of this falls right within the same zone. We want to do 38.62 of that net range? Let's do that also. These alternate price projections, 38 to 62. 38 all the way up here. There's the 62. So let's take a little review of what we have here. This is the real power of this dynamic price relationships and how we have specific relationships depending on the structure of the market. And when we get into the end of wave target zones, it's going to knock you out. But what we have so far is we just looked at all of the declines up to this point in time, this bar, and we made it pretty simple. We didn't muck up the chart with doing alternate price projections of every decline. We just looked at, well, this is the largest one since this top. More than likely, this decline is not going to be greater than the largest one. We had a reasonably tight range around 10%, 9%, 14.5%, and then one pretty short one here at 6%. So the maximum 100% alternate price projection, all these declines, so it's right in this zone. The 62% alternate price projection of the net range of this entire decline from this high was right in the zone. The 127% external retracement of this last advance, again, because we're anticipating that this is the last section down, the last section within this impulsive trend, came right in the zone. We did the 127, 162% of the last little advance, potential 1, 2, 3, last wave 4. We did the 100% alternate price projection of this decline, which would probably be a wave 1. This is such clearly so clearly 5 ways. There's no ambiguity here that I can go ahead and label those. And then we did the 38 and 62 of the net range of what I got labeled 1 through 3 from this wave 4 high. And that's assuming that this is the last section down in this trend, and this higher time frame is the last section down since this top. And they all came within a pretty tight zone. As of the last bar in this chart is right in that zone. So I don't know if it's going to be over or not, but what we would be doing now is looking for reversal signals for a probable end of the trend from this high, followed by, at the minimum, a correction greater in time and price than any of the trends since that high. So it could be fairly substantial advance, and potentially it would be the beginnings of a bull trend to even a new high. But let's just add some data on here. Well, we've already made some reversal signals. As you know, we've taken out a minor swing high and then added quite a few bars on here. And we've already made a greater advance than any since this top. More than likely, the trend has reversed to bullish off of this low. And we really pinpointed the probable price zone to complete this decline with our alternate price projections, and then we added external retracements. Fantastic, fairly narrow range zone to identify the end of a higher time frame trend. Well, let's begin learning about how to determine in advance the high probability price target zones for the various wave structures by doing the most simple one and the most frequent correction. And that would be ABC zigzag type of correction. So let's take a look at the data on this chart. It's the ES 240-minute data. I believe this data we also used in a prior lesson on alternate price projections. We're going to look at it in a little more detail with this example. Well, let's assume that we're in an impulse trend. This section is certainly impulsive, and we'll assume that we believe the market's in a higher time frame bull trend, and we're looking to identify the end of a correction in order to position side of the higher time frame bullish trend, which should eventually continue to a new high. As of the last bar on this chart, the decline looks like a 5-wave decline, probably not the completion of a correction. So if we have a 5-wave decline and we're anticipating that the market's making a correction, that could be just a wave A. And if it's a wave A, then we should have a wave B correction and then again a wave C correction. So I'm going to label this, as of the last bar, the most likely pattern position. Looks like a 1, 2, 3, 4. Don't know if that 5 is complete yet or not. When it's complete, it should be a wave A. We're making some assumptions for this example, but it's pretty much the same way that we think as a market is unfolding. So there I'll make a probable of 5. We got kind of a sharp advance, and then another decline to a higher low. That's probably a B. Well, if this is an A, and wave Bs are corrections themselves, aren't they? And so typically, or frequently I should say, a wave B is an ABC correction in itself. So let's begin by looking at what's a potential target for a wave B. Maybe we want to make a trade in the direction of the C. So the first thing we always do, if we're making a correction, we always want to do the retracements, the internal retracements. So let's put those on. And I just eliminate the 38.2%. That's not relevant. We can leave the 78.6% on, but the typical retracements for a wave B or wave 2 is 50% or 68%. So we have the key retracements on. And the second price relationship we want to put on is the alternate price projections of the wave A from the wave B extreme. So what's the typical wave C targets? Well, the minimum is usually 62% of wave A. The typical, really frequent, is the 100% of the wave A. And the maximum for a wave C is typically 162%. So let's put those alternate price projections on. Well, the 62% alternate price projection, of course, doesn't even come above the wave A high because this little wave B correction was so steep. So we can erase that, of course. Let me just clean the chart up here. So we have a pretty narrow range of the 50% retracement and the 100% alternate price projection of the wave A. And then up above the market, overlapping so close that we can't even read the numbers really. It's around 39.56. That was the 78.6% retracement and the 162% alternate price projection. So typically, this would be a really high probability target zone because it includes the 100% alternate price projection of this potential wave A. Of course, there are always potentials until they're confirmed. So that would be, as of the last bar in this chart, the ES is in a great position to have completed a wave B, a little ABC wave B. So is it in a position to make a trade? Well, we're going to talk a lot more about trade strategies later on in the course. But we'd at least want to be alert to some reversal signal. Maybe we're looking at momentum reversals or some other sort of technical analysis that indicates that it's making at least a short-term high for an opportunity to position short, because if this is making a wave B correction, then when it's complete, it should continue lower to below the wave A. That's just basic strategies. When a correction is complete, typically the trend prior to the correction continues to a new extreme. More than likely, it's not going to make a reversal around the 62%. It's either going to be around this level or this higher level, because that includes both the retracement of the wave A, which would be a target for a wave B, and those two also include key alternate price projections for a wave C. But I'm going to leave the 62% in there just because this is a fairly narrow range, so we want to be aware of it, even though the higher probability is one of these two. So let's add some data and see how the market acts or reacts around these price levels. There we are, one more bar right up to the 62% retracement. So now we're well above the wave A high. What would be an indication that this correction, an ABC correction, which is a higher time frame, wave B, is complete? What do you remember from the E wave course? Pretty standard stuff. Overlap with the wave A. So we've met at least the minimum target for a wave C of B. And so let's just add data. And we know now we're looking for any type of reversal. So as of the last bar of the chart, it's come above the typical target zone. We've reached that, which would really be the minimum target zone because it's the first target zone above the wave A high for a wave C. Hit the 62% retracement and then came right down and overlapped into the wave A. More than likely, this ABC correction is complete for a wave B. Let's add some more data on. I think we can be pretty sure that it's complete as of that last bar on the chart. So let me label this up and let me clean the chart a little bit. At least we'll take those off. So here we are with the probable ABC. And if that's the case, we can as of now determine the probable target for a wave C, at least a minimum and maximum targets to begin with. And this wave B is not confirmed until there's a trade below the wave A. So why don't I just wait for that to occur, assuming it's going to occur. There it is, as of that last bar on the chart. So now we're looking for a wave C target, and really doing the same thing we did at this smaller degree target for a wave B. So a wave C, number one, it's a correction, so we should be doing retracements of the impulse trend, simple retracements. We can see the low so far was right around the 38.2%, but as you're going to find later in this section of the price course, 38.2% is not too relevant here unless we believe this was going to be a wave 4 correction, then it would have been. So right now, we're going to continue on as if it's not a wave 4 correction. So we have the 50%, 62% retracements, the real common retracement from an impulse wave. And then we want to do the alternate price projections of wave A from the wave B high. So let's do those, and let's make sure that we've chosen. So we measure the range from the wave A, we do it from the wave B high, and again, 62% is above where the market is already, so we can get rid of that. So we've got two zones. The 100% alternate price projection falls again right near the 50%. And then again, interestingly, down near the 78.6% retracement is the 162% alternate price projection. More than likely, the wave C target, this would be the ideal target zone around the 50% retracement and the 100% alternate price projection. And this would be the maximum probable target zone. And more than likely, it wouldn't terminate around the 62%. And that's why I always say probability is more than likely, because in the last example, it terminated right around that. So we want to be aware of every correction, every trend doesn't end ideally in the ideal zones, but they still give us some good information. And so far, good information is that the wave C will probably reach at least the 38.45 zone, at least that, because that's the next alternate price projection. So what other price relationship helps us to determine the end of a correction or even a trend? Well, the external retracements in this case of a wave B. So let's do those external retracements of the wave B. And we want to do the 127 and 162. And they engulf or overlap, however you want to say it, the 50 and 100%, 50% retracement, 100% alternate price projections. So we've got a really strong price zone here. It's a pretty wide price zone, and it's focused right on the middle of this zone. So let's add some data on and see what happens here. Well, as of that last bar in the chart came right down and tagged the zone. A really good position to complete a wave C. And what would indicate that more than likely the wave C is complete? Well, if this market were to continue to advance well into an overlap of the wave A. But as of the last bar in this chart, we'd want to look at our other technical indicators and at least begin to develop a trade strategy. And just kind of basic strategy, if we took out this little swing high, we would be well into the overlap range of the wave A, having taken out a little swing high. That would be then put the ES in an excellent position, go long setup. Let's just add some data. Well, that just happened the next bar. So more than likely, this is a completed A, B, C correction because of the overlap. If by chance the ES continued sideways to down and made a new low, we would still be looking for the end of a correction because this overlap is very indicative of a correction, as you remember from the Elliott wave course. So we can put our label on here, probable wave C. Until we trade above the wave B high, it's still probable wave C. But what's really important here, let's clean the chart up and focus on this price zone. And we had the 50% retracement of the impulse trend, very typical retracement for a correction against an impulse trend. 100% alternate price projection of the wave A, again, the most frequent target for a wave A. And then the 127, 162% external retracements of the wave B. So we could kind of look at more than likely the extreme of a wave C is going to be down around this 162%. But the next bar traded into the range of the wave A, it's probably complete. And because we traded above this little swing high, we can, that's an immediate go long setup for a probable continuation of the trend to a new high. And indeed, the ES continued to a new high. So an A, B, C correction. Well, let's look at this data. This is Google daily data. And let's look at the data that I have in the chart here. This is an impulsive trend, obviously. And let's assume the higher time frame trend we at least believe is bullish, that the market is making a correction. And we want to do the best we can to identify the probable target zone for that correction so that if it reaches one of those target zones and we have some sort of reversal signal, whether it's a price reversal, pattern reversal signal, or a momentum technical signal that's a reversal, bull reversal, we could very early on enter near the end of the correction for a resumption of the bull trend. So as of this data, we've had a decline, then an advance, and then we've had a decline to take out the initial low. So listen to my language again. Google is in a position to complete an ABC correction. So let's identify probable pattern position, or excuse me, probable price position where a high probability ABC correction may be complete. So real simply, we do retracements of the impulse trend that's being corrected. So let's do those. And again, I just take off the 38. So I got the 50 and 62% retracements. Those are the typical retracements for a correction against an impulse trend. I do have the 78.6% on there. Then I do the alternate price projections. And again, 62% alternate price projection is above the current market, so it's not relevant. And if this is, we're going into the assumption, not the assumption that it is an A, B, and it's making a C, but it's in the position to make a wave C. Could continue to unfold in a complex correction. We just want to identify an ideal position for a wave C, because then we can make decisions. We can take specific trade action. So what's the third relationship that's typical of a wave C? It relates by one of the Fib ratios to the wave B. So we do the external retracements. Typically, let me close that. So what are the typical wave C relationships to the wave B? Well, it's usually the 127, 162, or even the 262 external retracement. So let's just make those. Interestingly, isn't this quite similar to the last example we looked at? And you're going to see this over and over and over again in your trading, all markets, all time frames. So I have the 127 and the 162 external retracements. Again, they fall just on either side of the 50% retracement and the 100% alternate price projection of the wave 1 from the wave B high. So this is a fairly wide zone, from 22.25 all the way down to 21.85, with a focus again right in the middle of it of the 50% retracement, 100% alternate price projection. But this would be the highest probability zone to complete a wave C. The maximum would be all the way down here, and then includes 78.6% retracement, 162% alternate price projection of the wave A from the wave B high, and then also the 262% external retracement of the wave B. And once again, in the 62% retracement of the impulse trend, there's no other relationships near there. None of the swings on the way down, where if a wave C were to be made here, it wouldn't be related, closely at least, to the wave A or the wave B. And because typically these sections within this counter trend should be related to each other, typically are related to each other, it's going to be at a zone that includes relationships of these two. So let's add some data on, clean it up a little bit. How do we think about this as we add the data? Well, there we have a bar that's come down really strongly, closed near the low, right into the range, just tagged 100% alternate price projection. Let's add another bar, inside day, but up day, because we've may be making a reversal from this zone. We might begin to formulate some sort of go long strategies, because now Google is in the ideal price position to have completed a wave C. What indicates that a wave C is probably complete? Well, it'd be a close into the closing range of wave A, and that's quite a bit above the market. In traditional Elliott wave guidelines, it would be a trade above the wave A low. So let's just add some data. Well, there we had another pretty strong up day. So we've traded well into the range of the wave A. We haven't closed into that closing range, but wouldn't we now want to be formulating a go-long strategy for not the possibility, but the probability that a wave C is complete? Just the ideal pattern relationship and ideal price target zone. Let me just move that over a little bit. There we go. It's okay. I got a question mark, and it's going to be a question mark until there's a close above the wave A closing low. But we're still in just a great position to consider a long trade because of the pattern and because of the price relationship where the market returned. So once again, we determined in advance the probable target zone for the end of a wave C. And once again, the market reversed right around that target zone. So keep in mind, certainly all corrections aren't made as ideal zigzag ABCs. But in both these cases, the markets have come down, made a probable wave A, probable wave B, and then have continued below the wave A extreme to indicate they're in a position to complete a wave C. Now, sometimes we have like contracting triangles and more complex corrections, and this wave A may not even get exceeded, and we continue in a complex correction. Well, that's another situation altogether. This is a situation that we're looking at. If the market is in a position to make a wave C, we can then identify the probable end of wave C target zones. In this chapter, you're going to learn how to identify the probable price target for a wave 5. So the end of wave 5 price target. In some cases, we'll be able to identify what should be the minimum target as well as the maximum target. Why is it really important to be able to project the high probability end of wave 5 price target? Well, remember from the Elliott wave course, an impulse trend typically unfolds in 5 waves, and the 5th wave is the last section of that impulse trend. So if we can identify that a market is in a position to complete a wave 5, or I should say if it's in a position to be in a wave 5, and then if we can identify the probable price zone, that would be the typical and or maybe the maximum target for that wave 5. That's really valuable information that we have to adjust our specific trade strategies, and particularly how to adjust the stops if we happen to be long the market, as well as identify reversal in the market, identify what would confirm that reversal, and then we would identify the specific trade strategy on the other side of the market. Plus, almost all corrections should end, the last section, should subdivide into 5 waves. So 5-wave trends are really important. A wave 5 of a 5-wave impulse trend should subdivide into 5 waves, as should all of the impulse sections of that trend. The end of corrections, again, subdivide into 5 waves. So there should be a lot of impulsive 5-wave trends in all the markets and all the time frames, and to be able to identify the end of wave 5 price targets, it can be really, really helpful. And there are some very specific ratios and relationships for an end of wave 5. And this is something very unique that I've discovered over the years. So let's take a look at that. So here's some daily data. It's of Amgen, it's a stock. And as of the last bar on the chart, Amgen is in a position to be in a wave 5. Now, listen to my language. I'm not saying it's a wave 5. I'm in the end of an impulse trend. I'm saying that's in a position to be making a wave 5, because we have a 1, 2, and a 3, and a very distinct wave 4. So good possibility of a wave 5. So we'd want to identify what's the probable price target for that wave 5. Well, as you learned in the external retracement section, the final section of most trends and counter trends will end around the 127 to 162% external retracement. So that's always the first thing we put on our charts if we believe that a market has completed a wave 4. Let me just label this chart a little bit so we know what we're talking about. Possible 1, 2, 3. That's a little ABC. Let me go ahead and put that in. Nice ABC for a possible wave 4. So as I always say when I put certain time and price targets and that sort of thing on for let's say a wave 5 in our reports, is I'll say that if waves 1 through 4 are as shown, here's the wave 5 price target. Because I never know if this market's going to continue much, much higher, make a lot more highs and lows. The only thing I know, it's in a position to complete a wave 5 target. Now, I may have other technical analysis that would indicate, again, that we're making or about to make a top. Let's just say we had weekly momentums or something that are overbought and maybe in a position to make a bear reversal. So if we're in a position to make a weekly high on some time cycle or some momentum cycle, then more than likely it's going to be a wave 5 high. So understanding and calculating where the end of wave 5 price target should be, or typically is, be real important. Okay, let's do the external retracements of the wave 4. So I'm going to click on here and make sure I got external retracements chosen. I didn't. There we go. Yeah, let's bring that data down a little bit. So there we have the external retracements of wave 4. And typically, a minimum target for a wave 5 is around 127% external retracement of wave 4. And typically, a wave 5 is complete by about the 162% external retracement of a wave 4. And that's typical if the wave 3 is, so far at least, the extended wave. That would mean wave 3 is obviously longer than wave 1. In most cases, the wave 3 is around 162%, the range of wave 1, as you'll learn later. But if the wave 3 is already extended, if it's considerably longer than the wave 1, then more than likely it will be the extended wave, and a wave 5 will be fairly normal. So what other relationships are there for the wave 5? So that's the key one, by the way. That's the number one to look at. So the second most reliable relationship is the comparison to a wave 1, wave 5 to wave 1. And typically, again, if it's we've already seen that the wave 3 is extended compared to wave 1 at least, typically wave 5 is around 100% of wave 1 or 162% of wave 1. So let's do a 162 of the range of wave 1 from the potential wave 4 low. There we go. Did you see where that hit? Well, right at the 127% external retracement, that's exactly within, I think, 1 cent of the 100% alternate price projection of the wave 1. So again, around that 127%, 162, or 100% alternate price projection. Boy, we want to really be awake around there, that would be a high probability target, not too far above the market for a wave 5, still with a maximum probable around 163. I can go down here. I think the 162 alternate price projection is quite a ways away from that, so these are certainly not close enough to consider them a zone. And so there's one other typical end of wave 5 target, and that's typically the 38 or the 62% alternate price projection of the net range of waves 1 through 3. In other words, the wave 4 is related to the net range of the impulse trend so far. So here we go to the alternate price projections. Look at 38, 62. From the wave 1 low to the wave 3 high to the wave 4 low. Well, now this is certainly interesting. Here we have the 38% alternate price projection is again within just pennies of the 100% alternate price projection of 1, 38% alternate price projection of the ranges of 1 through 3, and the 127% external retracement of 4. So this is a real high probability price zone to complete a wave 5. And we could look at it as the maximum targets all the way up here at, what's that, 267, 269. But because it doesn't have one of the external retracements of wave 4, and those are our two primary indications of the end of wave 5, that's very unlikely that it would be there. The maximum would be around the 162 external retracement. The market reaches around 259.50. You want to be really alert if you have other technical indicators for reversals or just a pattern reversal signal, because that would be in a position to complete a wave 5 at a high probability target zone that has the three key relationships for that wave 5. So let's add some data on the chart. So as of the last bar in the chart, again, did it continue to advance? It reached this target zone, didn't close above it, and as of the last day, it actually made that's called a key reversal day, or just a daily reversal signal, where the market made a new high and then closed below the close of the prior day. So that itself isn't, a go short reversal signal, but it's something to be aware of when you're in a pattern position and a price position to complete a trend. And does anybody else see something interesting on this last section up from the wave 4 low? Anything that might be useful or helpful to identify a trend reversal? It looks like wave 5 is subdividing into 5 waves pretty cleanly and clearly. So wave 5 should subdivide into wave 5. What's the target zone for an end of wave 5? Always look at each section independently. Well, the first thing we do is 127, 162% external retracement. My oh my. As of the last bar in the chart where it made the daily price reversal at the key price target zone for the end of wave 5, it was also the minimum price target for the end of wave 5 of 5. That's fantastic information to have there. So we'll get even more and more into multiple time frame, multiple degrees of price target zones, but the end of wave 5 target is really important to determine every time a market is in a position to complete a wave 5. That means you have waves 1 through 4. You're fairly confident that it meets all the rules and guidelines to have completed waves 1 through 4, and then maybe a market has made a new extreme, so that means it could be in a position for a wave 5. Then you want to identify what the market can do to complete that wave 5 by identifying the price target zone and some reversal strategies. So this is just a great example from not too far back. Well, let's take a look at the data we have on the chart. It's closing data, and it's daily closing data for Google. So let's just assume, as of the last bar in this chart, that we believe that this advance is a wave 1 or a wave A. Maybe we're not convinced which that might be. And the market is making a wave 2 or a wave B correction. In other words, we're going on the assumption that this 5-wave advance is complete. We're going to make a corrective decline. Could be a 2, could be a B. So both wave 2s and wave Bs tend to subdivide in the same way. So for instance, a wave 2 is a corrective structure. Most frequent corrective structure is an ABC zigzag, but can be lots of other types of corrections. A wave B is a corrective structure. Again, it can be all kinds of different types of corrections, but by far the most frequent is the ABC. So we're not going to be really concerned with that at this time, because we're going to be concerned with the price target zone for a correction to a wave A and a wave B. So really all we have to work with, there's one primary relationship we have, and that's the retracements of this potential wave 1 or A. I guess I should put wave 1 or A up here, because we're frequently looking at a correction as being a wave 2 or a wave B. And we won't get into that in this example, but because they themselves are about the same, is their price relationships are about the same. So let's just do our retracements. We begin by doing typical retracements of this 5-wave advance, and let me put those on. I have them listed as the dynamic retracements in my set in here, and that's the 38, 50, 62, 78.6. So I've got those retracements on. Now for a 2 or B, the 38.2% retracement is irrelevant. Potentially, if this were a very extended wave 1, if there's some other circumstances, we might be looking at the 38.2, but it's a big mistake to have that on your chart for a typical wave 2 or B correction, because it's very rarely that wave 2 or B correction is that shallow to only reach the 38.2%. So I always just focus on the 50, 62, and 78.6. And of course, the 78.6% is fairly unusual, but it's frequent enough that we want to be aware of it, and also because it's typically the maximum retracement if the market's making a correction. And a wave 2 and a wave B, they're both corrections. So our key relationship is just the one relationship of the retracement of the wave 1 or A. And that's typically around 50% to 62%. So when I'm looking at a market and trade strategies and price relationships, if I strongly believe that we've made a wave 1 or an A, what I usually look at is that, well, probably the minimum target on the downside before a correction is complete is the 50% retracement. The typical range then reaches down to 62% or 61.8%. So I'd want to be looking at the pattern position on the decline if it reached one or either of these two retracement levels to determine if the market's in a position to complete that correction. And so what's the other relationship that we look at? Well, we look at the internal relationships of the possible A, B, C, D, E, however the correction seems to be unfolding. For instance, if this is a corrective decline, then we've had a section down, section up, so we could certainly look at this as an A and a B, and then we would do the targets for the wave C. We've already had a lesson on that, and so those targets would typically be around the 100% alternate price projection of A, and then those external retracements of B. We've already gone through that. What we want to focus on now is real simple, is the retracement levels. And probably the main thing I want to get across in this lesson is that for a wave 2 or B, forget about the 38.2% and always have on your chart the 78.6%. I mean, certainly if a market declined below the 62%, you want to be aware of the 78.6%. Now, old style academic Elliott wave people, you'll still see them talk about or claim that if a correction exceeds the 61.8% retracement, then more than likely it's a higher time frame trend change. And it's not making a correction, it's a new trend. That's absolute nonsense. Please don't fall into that trap. It's just not the case. Frequently, you'll see corrections exceed the 62% and reach around the 78.6%. And as we know from Elliott wave rules, as long as the market hasn't exceeded the beginning of this whole trend, it's in the position to be making a correction. So there's other pattern relationships on the way down that help us to determine if it indeed is a correction. But we're just primarily interested in the retracement zones for a wave 2 or a wave B. The typical retracements for a wave 4 are around the 38.2% retracement of the wave 3 to the 50% retracement of wave 3. Those are the typical retracements, and again, that's where the 38.2% retracement comes in. It's very typical for a wave 4. In fact, we usually would look at that as the probable minimum retracement for a wave 4, around the 38.2%, of the wave 3, up to the 50%, and to the maximum of around the 61.8% retracement of the wave 3. So I've got some data marked off here from this high. This is silver data for a possible 1, 2, and 3. So if these waves 1 through 3 are valid, we can identify the probable retracement levels for a wave 4, the typical and the maximum, and then we can use other relationships like how the wave 4 may be subdividing, that type of thing, to refine that. But we're just going to be concerned now with the most important ones, which are the retracements of wave 3 and the alternate price projections of the wave 1. So let's get our wave 3 retracements to begin with. I use the dynamic. It's the retracements of the wave 3. We got 38, 50, 62, 78.6%. Well, I'm just going to eliminate the 78.6%. I do have specific sets just for the wave 3, but I'm going to go ahead and do all of the dynamic, and then it's more instructive if you can see me mark off and which ones I keep and which ones I don't. So I usually have the 61.8% 1.8% in red, because that's typically the maximum for a wave 3. And then I usually will have the 38 as a green, because that is typically the minimum for a wave 3. Or excuse me, a wave 4 retracement. So we've got those retracements set. And we can see as of the last bar in this chart, as the silver has already reached the 50% retracement, actually poked above it, then closed right in the zone between 38 and 50%. And we know the maximum is not too far above the market here. And if we look at traditional Elliott wave, who believe that a wave 4 should not trade into the range of a wave 1, and it's a worthwhile level to have on your chart. It's where old support becomes resistance. Although, you know, from the proper way of looking at that, or the better way, or the more reliable way, is that a wave 4 can't close into the closing range of the wave 1. Now, that's a long ways above the market on a close. The wave 1 low is not too far above the market. What we can say is that typically this market is in a position, a price position at least, to complete a wave 4. And then we can do the alternate price projections of the wave 1, typically the 1 and the 162. The 162% is right around where that 50% retracement is. So as of the last bar on this chart, silver is in a position to complete a wave 4. So if we believe that silver is making a wave 4, that's the ideal price position for it to be in. Now, we could always, in this case, go into some intraday data, maybe the 60-minute data or the 240-minute data, see how this advance is breaking down, and if there's a smaller degree time frame target. But right now, we're going to be concerned with just the wave 4, the key relationships. Now, I want to tell you about one relationship I used to look at a lot. A lot of people promote it, and it's really not relevant. And here's why. That relationship would be the retracement of the waves 1 through 3. It's just not relevant, and it's for a logical reason, is that what are we retracing? We're retracing this section down. We're not retracing this entire section. We don't know if this is a completed section or not, but retracements are just relative to the last section are a completed structure. Like the retracements of a 5-wave structure are relevant. The retracements of a 3-wave structure, when we believe it's in an impulsive trend, are not relevant. So a lot of people just, they start marking up their charts with all kinds of retracements and alternate price projections, looking for so-called clusters. But it's clusters frequently of irrelevant relationships. You only want to make your price projections of relevant relationships. And in this case, it would be the retracements of the wave 3, not the retracements of waves 1 through 3. So as the last bar on the chart, silver is in an ideal position to have completed a wave 4 correction based on the price position. I'll add some data onto this chart. So far it looks pretty good. And then as of the last bar on the chart, indeed, silver began to decline. So there's, of course, a lot more that goes into the whole price or the whole trade strategy than just the price. But what we know as of this bar on the chart is that silver was in a position, a pattern position, and a price position to complete a wave 4. And in fact, it was fairly near what is typically the maximum price position for a wave 4, and that's the 62% retracement. So we would want to be alert to trade strategies, reversal strategies, as of that point in time, based on the pattern, based on the price position. So lastly, of the key relationships at least, let's take a look at the probable projections for the end of a wave 3. If we believe that a wave 3 is developing, we've really only got 2 prior swings to compare it with and relate it to, and that's the wave 1, which was an impulse in the same direction as the wave 3. That's the key relationship, is the relationship of a wave 3 to wave 1, and there also is the wave 2. Let's begin with the key relationship, and that's how a wave 3 usually relates to a wave 1. And that key relationship is a wave 3 is most frequently around 162% of the range of a wave 1. So typically a wave 3 is what we call the extended wave of waves 1, 3, and 5. Extended waves means that wave 3 is usually longer in price and also usually in time, but not always, the wave 1 and the wave 5, the two other impulse trends within that 5-wave impulse trend. When we make our relationships for a probable target for a wave 3, I always put on the chart the 100% and the 162%, being the 100% is typically the minimum of the 3, and the 162% is the more typical relationship. So let's do that on this chart. Let's get our 100 and 162. And if this is a 1 and this is a 2, we want to identify a probable target for a wave 3. There we go. We'll measure the range of the potential wave 1 from the potential wave 2 low. Notice how I always say potential. And as of the last bar in the chart, at least, and this is silver daily data, by the way, is silver has exceeded the 100% alternate price projection of wave 1, and that's very typical, very frequent, that it exceeds the 100%. Hasn't reached the 162%, but that would be the typical target. If silver were to continue to advance, we'd really want to be alert if it gets around the 162% alternate price projection. So I chose this example because it's not a real ideal example, and there's some decisions to be made here. And that's basically, what's this wave 1? What's going on here? This is obviously a correction against the initial advance, and then it's obviously another impulsive trend, which is so far exceeded the 100% alternate price projection. So it's very legitimately and very confidently we can say this is a probable 1 and a 2, and it's in the position to be making a wave 3. But what about this high on this day? Look at what the bar looks like, is that it made a significant new high that day, came down and closed below the mid-range of the day, and actually just closed up couple cents or so, not too far up anyway, from the close of the prior day. So what's the deal with this bar? As you've seen in some examples that I've used earlier, and as well as in the Elliott wave course on how we count some of the waves, is sometimes we ignore the news event bar if at the end of the day there wasn't a significant change in the close, and we ignore the extremes for the day at some time, or at least we can consider ignoring it. If I wanted to ignore this day and just say, let's say right around here, either one of these highs, that's a double top basically, consider that the end of the wave 1. Let's just do our alternate price projections in that case. And I'll go to this one. If we do the alternate price projections in that case, as of the last bar in this chart, we've reached the 162% external retracement. So if we ignore this volatile, I'm sure there is a news event that day. If we ignore that, we're right at the typical end of wave 5 target zone. So the other thing I like to do when we have a volatile news day that looks like it's kind of messing up with the a smooth Elliott wave count, is I'll just do it on closes. Let's just see where a close only alternate price projection would be. This is certainly looking a lot different when we look at the close only. We get rid of that volatile news day. So I need to change the alternate price projections here to closing data. So let me click on closes instead of the high-low. We'll go OK. And now let's do the alternate price projection based on closes. And that would be right at this level, again, right about where the market is based on closes. So I'm going to keep these levels. Just want to clean the chart up. I'm going to go back and put the intraday, the daily ranges on. So we know at the level here, 2447.9, that's 162% alternate price projection based on closes. So based on closes, silver has reached within a penny or two of the typical end of wave 3 price target zone. And based on ranges, when we ignore this news day, it's reached the 162% alternate price projection based on ranges. So in other words, as of the last bar in the chart, we know that if we consider this a 1, this could be a 1, either one. Let's just look at that as a 1 and a 2. We're in a position to complete a wave 3, and that's how we phrase that. We're in a price position from where a wave 3 is typically complete. So let's add some bars onto the chart. Well, we had a pretty sharp reaction against that. So again, I don't like to always use just these perfect examples because the markets are not perfect. They're sloppy a lot of the time. So you have to make just some simple logical decisions. And that was a pretty good decision to make based on eliminating this one volatile news day, which made the new high and then closed below the mid-range of the day and really didn't change the trend of the market at all based on closes. So here we are as a probable end of wave 3, right in the typical retrace our alternate price projection zone. We can do external retracements of wave 2. And I typically don't do those because usually if you have your alternate price projections of wave 3, and by the way, retracements are not of any value for a wave 3, otherwise doing retracements of the prior decline in this case. Of course, we already know that it's come up to about where this high is, but we're not looking for a correction. Retracements are only valuable for corrections, not for trend targets. So again, you'll see many people, they're looking to identify like where a wave 3 would be. They would do retracements of a prior decline, and it's just not relevant. And just think logically, why would you look at a retracement when the market's in an impulse? It's not making a retracement, it's in an impulse. So again, don't put on your charts just a whole bunch of gobbledygook, doing retracements, alternate price projections, all that sort of thing, willy-nilly. Only put those on your chart that are relevant to the market position. And the first market position you decide on is the market in a trend or is it in a counter trend? The other price relationship that you can do for a wave 3 would be the external retracements of the wave 2. And particularly if you've read and studied any of Tony Plummer's work, which is all excellent, he shows you about, we might call them shock waves or the initial reaction to the initial correction. And that would be the retracements of the wave 2 to help target, in this case, it could be the end of the wave 3 or the entire section up, the end of the entire 5-wave impulsive advance. I don't do them very often, but sometimes I do. They're useful because the wave 2 correction is related to the next section, which is the wave 3. And we always look at how each section, we can call them subdivisions, within a trend or impulse trend are relating to those subdivisions that came before. So let's do the external retracements of wave 2. I'm going to ignore that volatile range. Let's see if I've got the proper ones chosen here. Yeah, we begin with 162 and we go up to 423. So we're going to do the range from the wave 1 high. This is actually the price low. This is what I would consider, let me put those on, a probable ABC, more or less an ABC flat correction, but it didn't end until this low. we could also look at it as if this was the wave 2 low, and then we started 1, 2, 3, 4, 5. So, but the point would be, however we look at it, this would be the range of the wave 2. So here we are at the 100. Of course, 168% is probably not going to be relevant, not for a wave 3 anyway. 262 could be relevant, already way past it. Just happens that the high on the chart so far is right near the 423% external retracement of the wave 2, which is right near the 262% alternate price projections. So sometimes I'll use those, not that often, but the relevant ones for a wave 2 are strict Fibonacci series: 162, 262, 423. And so you don't want to do those external retracements like 200%, 300%, 400%. You're putting in ratio relationships that are not relevant to the unfolding structure of this pattern. So that's for a wave 3. And of course, we'd refine our wave 3 targets by breaking down the internal subdivisions and then looking for a probable end of wave 5 of wave 3. So those are the keys for wave 3. So this data is British pound daily data. And let's go under the assumption that we believe this is a completed 1 and a 2. Where would the typical wave 3 be? Well, the first thing we do, and usually just the key relationship that we need on our charts, is the 162% external retracement of the wave 1. So I've chosen those two. Let's measure the wave 1, do the 162 of the wave 3. We're already well beyond the wave 1 100%. That would, at the 100%, it would look more like it's making an ABC, not a 1, 2, 3. But if, for whatever reason, we believe this should be an impulsive decline, then certainly we can just get rid of the wave 1. It certainly has to be further than that. So again, we have to think logically as we're doing our patterns, our relationships, etc. So we're going to add some more data, and we'll see what happens if it comes near the 162% external retracement. Well, I fast forward here a bit, and we can see as of the last bar in the chart, Euro Pound has reached the 162% external retracement. That doesn't mean it's going to stop the decline or that's going to end the wave 3. Here's what we know. We know that we have 3 distinct sections down, probable 1, probable 2, and we know as of the last bar in the chart, the Euro Pound has reached the ideal price projection to complete a wave 3, around the 162% alternate price projection. Let me add some more bars on the chart. Well, there I've added some more bars on the chart, and it's the Euro Pound has exceeded the 162% retracement. It came down a couple weeks later, maybe 3 weeks later, and tagged it again right from where it did on that previous bar. And in fact, if we look at this, looks like a little 1, 2, 3, 4, 5 going into that low. And if we ignore this as a news day, that would be a nice spot where probably we would be developing a trade strategy related to this wave 3, if it's a wave 3 at least, was probably complete. Well, it had a kind of a minor reaction against that of a few days and then continued to a new low. So we're going to ignore a lot of the other potential pattern positions and technical positions and just keep with the idea that we're in a position to complete a wave 3, and at any time we make a reversal, is that we're in a position to have completed that wave 3. So we might, for instance, want to do one more price relationship here is the external retracements of that last swing up. So why would we want to do those? If we're in a position to complete a higher time frame, any new low could be the last minor low, the last subdivision low, and those are usually complete at the 127, 162% external retracements. So as of the last bar of the chart, again, we'd want to be developing a strategy that would indicate that this decline is complete. So I had, well, ooh, boy, there we go. In 2 days, a sharp advance to above this high. So we're not going to get into the details of the trade strategies related to this. The lesson here, as far as the end of wave 3 target zone, is that going back here, this is actually a few weeks earlier, the euro pound had reached the typical end of wave 3 price target zone. Then we'd want to look at our other pattern, the subdivisions, the other technical analysis, and say, is this market in a position to have completed? In this case, the wave 3 should be at least a multi-week, if not multi-month low. We ended up having a 2-bar retracement, and then we continued to a new low. And then again, we came down and tagged it again. We'd ask that same question. We'd say, the euro dollar's in a position to complete a wave 3. What would indicate that that wave 3 is complete? What kind of reversal based on pattern, other technical indicators, so that we could then develop a specific trade strategy based on it being in the price position to end a wave 3. So we did have a mild reaction against it, went to a new low. Once again, we say the euro pound is in a position to have completed a wave 3. What other price relationships is it at? What kind of reversal signals would indicate the wave 3 is complete? And so we had the other price relationship is that the last decline, typically within an impulse trend, and this is certainly an impulse trend coming down. However you want to subdivide it, we look at this as the last advance and then potentially the last decline. Usually terminates around 127, 162% external retracement, so that's not far below the 162% alternate price projection of the wave 1. So we just want to be aware that we're in a position to complete that decline once again, higher time frame decline, wave 3. And certainly after the next 2 days, we've taken out the prior swing high and made a new high close as well. We've closed above the closing highs of the prior swing high. We just had a firm signal that a higher time frame wave 3 is complete and a multi-week to multi-month low is probably complete, based around the 162% external retracement of the wave 3. In this lesson, we're going to take a look at a few of less frequent patterns, but they're frequent enough that you should be aware of when they're unfolding and the probable price position and how price can help you to decide where the market is within that pattern. For instance, we'll take a look at like a contracting triangle, which outside of 3-section ABCs is probably the most frequent correction that we see. And that'd be an ABCDE contracting triangle. We'll take a look at a 5th wave ending diagonal, where a market makes a new high, but that 5th wave, the sections are overlapping and indicating that it's the final section of a trend and the price relationships of that. Because our objective is always that once we identify what the probable pattern position is, what more than likely is going on, then we can use price relationships to help us identify if that market's in a position to complete that wave structure or that pattern. And that's the whole objective here. Not to identify the details of every little section. The more we can, the better. But really the final objective is, for instance, if we believe a market's in a correction, is be able to identify if it's in a position to complete that correction. That's where price relationships can really help us. So before we begin, I just wanted to apologize. The last lesson, after I edited it, I found that I must have had dyslexia of types of price relationships. I kept confusing back and forth, particularly when I said 162%. I'd confuse it with external retracement and alternate price projection. When I'm talking fast, sometimes I don't catch those mistakes as I make them, and I had to put some little text bubbles in to make those corrections. I apologize for that. I'll try and keep more cognizant here so I don't have to put those little text bubble corrections in. Okay, let's get started. Well, this is daily data with gold. Let's just take a look at the data up through the last bar in the chart. Is from this high, obviously this is an impulsive trend up, fairly significant trend up. We had a fast decline. And we look at that as an impulsive trend. So if it's a decline, it shouldn't be a completed correction. It should be a wave 1 or a wave A. We don't know, we don't have a firm opinion of what that would be without putting more data on and looking to see what the pattern, higher time frame pattern was going into this top. Let's just go under the assumption that our technical analysis, our pattern position, etc., is indicating that gold is going to make a correction, and eventually when the correction is complete, it would be followed by a resumption of the bull trend. So we're going to go into the assumption that this is a wave A. So let me just put that in, that is a wave A. This is potentially a wave B, and if so, then gold should be making a wave C correction. Typically, that would exceed this low. Sometimes we can have some kind of contracting or irregular wave C, but the assumption is always to assume that it's going to be the most frequent and the most obvious, which is ABC zigzag. So let's just add some bars on the chart and see how that works out. So we have some bars on the chart here. I could even look at this, and I'll bet I could, if we had the intraday data, which we don't need, but we can look at this and go 1, 2, 3, 4, 5. And then we had this outside, big wide range outside day. So kind of impulsive, but it looks like it made a new closing low, but then just immediately reversed up. Not typical if this was going to be a wave C. So let's add some more data on here. So now's when I'm going to start putting some price relationships in, because this whole pattern is getting kind of sloppy. So this could be an A, could be a B, but more than likely, since we've just come down a ways, just below these little lows here, and come up several days into this range, we're going to probably look at this as a potential maybe an A and a B and a C, that the wave B is making an ABC. Let's do something like that. And before we do that, let's put some retracements in. So the initial advance was well below the 78.6% retracement, within the typical retracement for a correction. Let's do another retracement of this advance, right down to the 78.6% retracement, and then it had a fairly sharp advance. So let's take a look at, I'm going to look at something here. I'm going to put the 78.6% retracement in as of the last bar in the chart, which the market's come right up to. If the market is making some sort of contracting correction, a contracting triangle, it should be bounded, typically at least, by the 78.6% retracements, because each one of these sections is a correction to the prior section. So let's add some more data on. Pretty sharp decline. I'm going to put another 78.6% in here. Let's keep adding data. Came down to test that 78.6%, went beyond it a bit, but then it didn't close below it. Let's add another one in here. What's going on so far? This is almost, oh boy, we just hit the 78.6 as of the last bar on the chart. What's happening here? We have the first decline, and an advance, again a decline within the 78.6% retracement, indicating this is potentially a correction, an advance to the 78.6%, indicating this is part of a correction. So, and then another decline within the range of this decline. These are all the definition almost of contracting triangle, of an A, B, C, D, E, of which each of the shorter sections that follow the prior section is contained more or less by the typical retracement, or the maximum retracement typical for a correction. If that's the case, let's just do a count here. let me go ahead and get the letters up. A, B, C, again, D above wave B. And if this is the case, we should complete this 5-wave contracting triangle below the wave C. I mean, that would be typical at least. Markets, of course, can do everything. But as the last bar in this chart, it's in a position to have completed an A, B, C, D, E. And that's what we're striving to understand, is a market in a position to complete a correction? Well, we can phrase it this way. If this is a wave A, and now we've gone 5 sections, each of them with lower highs, higher lows to make a contracting triangle, with the last bar in this chart in a position which would typically be the maximum for the wave E, then we're in a position to develop a specific trade strategy based on the pattern position and the price position. What strategy would that be? Think of something just really simple if the market were in a position such as this. Well, certainly a close below this little swing low close. Rephrase this. If gold were to decline and close below 1947.90, it would be in a position to have completed an A, B, C, D, E correction. And if it's that should be a wave B of higher time frame, which should be followed then by a continued decline to a new low. We didn't know as this was unfolding exactly what was happening. But we have now gotten to a place where we can define probable position and state that it's in a position to have completed an ABCDE correction. And that's a fantastic piece of information to have, because if a market's in that position, and let me just put the B up here, and of course it would be a B with a question mark until the market, gold would decline below what I got labeled as the wave D low, is we don't know exactly where we're at. But a close below 1947.90 would be a really good setup for a probable continuation to a new low. Let's go ahead and add some bars on the chart. We actually, looks like we traded about a tick higher the next day. Well, we certainly closed below the 1947.90, and in one day we also closed below the wave, what I call the wave D swing low, and we traded to a new low below this whole contracting triangle. More than likely, this indeed is the completion of a wave B, and we're going to continue the decline to complete a wave C. So let's take a look at this data. It's a Bitcoin daily data. I'll move it over a little bit. And as of the last bar in the chart, boy, it really looked like it had made this ideal major 5-wave advance into this February high. We won't go through all the details of it, but this was a potential wave 3 and a 4, and then this beautiful 5-wave advance to a new high, and then a fairly dramatic reversal, at least for a few days. Great position for a wave 5 high. Let me add some data onto this chart. Well, just as of that point in time, we've got a warning that this probably has not completed a wave 5 high. This really looks like an ABC correction. And certainly if Bitcoin were to come and trade above this little swing high and close above that high close, this would look like a correction and not the beginning of a bear trend following a major 5-wave advance. Well, it happened as of that point in time. So what is one alternative that could be happening here? And that alternative is, this is such a beautiful, impulsive 5-wave advance. If this is pretty solid as an ABC wave 4 correction, this then would have to just be a wave 1 of a wave 5, of a 5-wave advance. So we can look at this, and this is a real situation. I can remember this occurring back at this time period. And this was an alternative, but it was hard to accept that alternative because it was such a dramatic, impulsive advance to a new high after this probable wave 4 low. We could go back and look at data prior to this, and that it was a real solid 4 waves up into that. So if that's the case, this is potentially a 1, and this is a 2, and let's go ahead and add some more data. That would imply that the market's going to go to new highs. And there, as of this bars on the chart, it's already made new highs. I'm just going to add some bars. I'm not going to go through this every single bar by bar, but I'm going to go through until we get to what I call significant waypoints. So as of the last bar of the chart is Bitcoin has made a new high, but then it's come down well into the range of an overlap range of what this high is. So is it making another impulsive 5-wave advance, that which wave 5s typically are? Well, probably not. It's probably doing something else. So what is the possibility, or we can even say the probability, if a market makes a new high and then comes down and trades into the range of the prior swing up, and then if it continues to another new high, what is that probable pattern position? I'm just going to add some bars onto the chart. Well, and that's exactly what has occurred. Now, as this was unfolding, we could speculate or kind of guess what the probable position is, and that is that it's making an ending diagonal. And I'm going to add some data or some labels on here. Potentially a 1 and a 2 and a 3 and a 4. And if that's the case, this would be the final section up. So what is an ending diagonal? An ending diagonal, of course, is higher highs, higher lows. At least this is one form of it. But they continue to overlap with each other. Or I should say the wave 4 clearly overlaps into the range of the wave 1. Well, what would be a probable pattern position of the new highs? And it's typically, they're either the 127, 162% external retracement. Let's put those on. Here's 1 and 2. What I got labeled a wave 3 is just short of the 127% external retracement. Let's do the external retracement of the potential wave 4. So let's clean the chart up here. So we have a potential 1 to a 3 right around, a little short of the 127% external retracement, a corrective decline, a new high right to the 127% external retracement. We're in a position to complete a wave 5 diagonal. And that's pretty significant because this is the 5th wave of a much longer bull trend. And this, because it's made new highs, decline, new highs, decline, new highs, this should be the final section up if we're pretty convinced that this is a suitable wave 4. And that means that as of the last bar in this chart, we're in a position to complete an ending diagonal at a typical price target for an ending diagonal. It means as of the last bar in this chart, we want to be aware that we could be very close to a very significant high that's going to last many months. And both the pattern and the price position are indicating to us we want to develop a strategy that recognizes if the top has been made. And certainly as of this point in time anyway, it would be a close below this little swing low close. And possibly, if the market continued to advance, we could develop a different strategy. But as of now, what we can say is Bitcoin is in the position to complete a wave 5 of 5, of which the wave higher time frame wave 5 is the ending diagonal, and that would probably result in a fairly significant reversal, and it's in a price position to complete that higher time frame trend. Let's just add some bars on the chart. There we had a reversal day, a little inside day, a decline. As of that bar in the chart, we've probably completed a multi-month high, if not even longer time frame, in Bitcoin. And it's all based on simple pattern position without getting paralysis of analysis and simple price position. Let's look at one more example, an unusual type of situation, but where it becomes clear when a market is potentially in the final section of a correction or a trend, either one, how we can use price projections to help us identify the end of that final section of the subdivisions of the final section, which has the potential to complete a much higher time frame. So this is daily data of the euro dollar. And we had an ABC correction, which at the time, and I could tell you at the time, I believed was in the position to have completed an ABC correction followed by resumption of the trend to a new high. However, what occurred? An ABC advance came back down and closed into the range of what I now have labeled as a wave A, indicating that this corrective decline, higher time frame, was not complete. So what do we call it if we have an ABC decline, then an ABC up, and then we continue to a new low? Well, more than likely it's going to be a double three, what we call a double three, and we'd be better to label that as a higher time frame W, X, and then we're making a Y, which would typically, as it said, a double three, which would be another A, B, C correction. Well, we certainly had a clearly defined decline to a new low for an A, a clearly defined A, B, C correction for a B. So if this is correct, that this is a double three and a W, X, and a Y, and this should be another A, B, C, since we made a low below that A, that means that any time we complete this wave C decline, it would complete the much higher time frame trend. So it would behoove us to use all of our tools to identify the end of this wave C, which would typically, should be, a 5-wave trend, because that would put the euro in a position to have completed the entire decline going back here 2 or 3 or 4 months or however long it was. This is daily data, so it would be back into January, and we're currently at the end of March here. So how can we use price position to help us in this situation? Well, we can have a couple relationships that are pretty typical. We'd want to compare this ABC to this ABC. We'd want to compare this probable wave C to this A by the simple alternate price projections. Let's put those in and just see where we're at. So we'll choose the 62, 100, 162 alternate price projection. And let's see, we've got those checked off, all three of those, 62, 1, and 162. So let's just do those for both of these sections, the higher time frame ABC and we can call this lower time frame, I guess, the A compared to the C. Well, of this ABC is already the euro's considerably beyond that. The 162% alternate price projection is around the swing low, so certainly that would be the maximum on the downside. And as of the last bar in the chart, it's reached what we'd consider the minimum for the wave C, which is the 62% alternate price projection of the wave A. So now the big question is, we know we've met at least the minimum probable target to complete this second ABC, and the maximum's down around where this swing low is. So now let's take a look at this decline, and let's not get paralysis of analysis and have to go into intraday data. Usually it's pretty clearly on the daily data. Pretty clear, it looks like to me, decline, correction, decline, kind of sideways correction, decline to a new low. I could look at this and say probable 1, 2, probable 3, 4. If that's the case, we should be within a bar or two of completing this 5-wave decline, which should complete the much higher time frame double 3 correction going all the way back about 4 months ago. So let's see if we can identify the price target for the end of wave 5. So what do we begin with? Let's begin with some alternate price projections. I think I already got 62.1 and 162. So we'll measure the wave 1 and do it from the probable end of the wave 4. That's the 100% alternate price projection where 5 equals 1. What's the other alternate price projection relationship for a wave 5? Well, it's the net range of 1 through 3 from the wave 4 in either 38% or 62% alternate price projection. Let's keep that guy. 38% alternate price projection. So we've got two of the key end of wave 5 price targets. Now I can just look at this and say it's considerably more than the 162% external retracement of the wave 4. There's the 162. So we're near what should typically be around the maximum of a wave 5. We've reached the minimum for the wave C. We should be looking at any time we get a reversal signal that would indicate this wave C is complete. We've got a good probability of completing the much higher time frame going back to that January high, a multi-month low, and a potential then for resuming a bull trend to a new extreme if this is a correction. What follows a correction? So we're in the price relationship for an end of wave 5. We're around at least the minimum price target for a wave C. Boy, let's develop a go-long reversal strategy. Well, certainly a close above the closing high of the wave 4 of C of Z. And that's quite a ways from where the market is at this point in time. And of course, if it continued lower, we'd have to reevaluate what the pattern position is. But let's just add some data. Well, it's quite a ways up from where the low is so far. What's the potential on the upside once this signal is made? Potential for a new high. So that would be a great signal. And our pattern and our price relationships indicated that we're probably at or near the end of that bear trend and that higher time frame correction. As of the last bar in the chart, we've clearly signaled from the pattern and price position that 1, 2, 3, 4, 5 of C. I'm gonna put all these relationships on, which should be a Z, or excuse me, a Y, is probably complete. It all fits in beautifully, and really the key piece of information here, I believe, is the price position to complete this decline and then the reversal, pattern reversal signal of the close above the probable wave 4 closing high. All done without going to intraday data. This is an immediate setup for a long trade for a high probability of continuing a bull trend with very minimal capital exposure considering the upside potential. Well, there's a few kind of non-traditional, non-typical examples that we've gone through. So what's important is to learn how to think. Think about the pattern position. Think about if a market's in a position to complete the last section of a trend or counter trend, and what would be the price position, the extreme probable price target position to complete that trend or counter trend in the last section of that trend or counter trend. Think logically, keep it relatively simple, and I think you'll find using price relationships and probable pattern position will be really, really valuable to you for every market and every time frame.